Bill, you and I met through an investment online. Uh, what is it? An online group run by Strawman Andrew Page. You got to do a shout out to Andrew.
Absolutely.
And we have progressed at different speeds in our Bitcoin journey and our investment journey.
Yeah.
You've been an investor for 20, 30 years.
Yeah.
Me for about 5. You've worked in businesses, managing accounts.
Yeah.
I've come from the teaching sector to now managing a business. And we've had very different routes, but we both are very passionate about Bitcoin, education, and the problems in society and in the world at the moment. You've got 2 young men that are growing into adulthood and wanting to have families, and you're seeing the problems with the world, and we're going to talk about that. We're going to talk about what Bitcoin is, why it's important, and what the problems are with the world, and that there are solutions there if you look. So we are biased in our opinions.
Yeah, big call out on that one. Yeah, that's right. Where we are today, we see eye to eye on many things. That's important to probably put out there for everyone to recognise. But it comes from, I think, an experience. Like, I'm a 51-year-old, from experience in business, both running businesses but also being in some big corporates, and then electing essentially to not be in business and being self-sovereign. So, but Bitcoin, I think, provides us a lot of hope, and that's important. So hopefully we're able to share some of that logic.
I mean, you're here sharing your time because you care about educating people around it, and you speak about people about it all the time. Yeah. So do I. We're sick of forcing it down people's throats. Yeah, it's uncomfortable. And if you've found this channel, you've found this recording, you're seeking answers that might be there.
Yeah.
So your investment journey, like, I'd like to just chat about that real quick. What is an investment philosophy? Why do you invest?
Yeah, I mean, I was always someone pretty ambitious as a young person, whether I was playing sport or whether I was then in the workplace. And so always career progression was a key thing, and then wealth accumulation. So lived in a very, very fortunate time where interest rates were falling and we saw asset prices rising, and we continue to see that at the moment. So when I look at an investment, I never thought of what I was doing as an investment approach, but it was sort of, I was doing that. I was doing investing because I saw it as a mechanism to get further ahead with what I was saving and putting to work. So learned that quite early on, that if you spend less than you earn, you put that to work. If you put in the right things, they appreciate over time, appreciating assets. So that was sort of embedded in me. Because I grew up my mum brought myself and my 2 sisters up. So, I saw the heartache and what she had to sacrifice to provide for us. So when I look at investment strategy today, it's evolved enormously. And, I look at, you want to beat the cost of capital. So the cost of money, that's what capital is.
The interest rate?
Yeah, pretty much the interest rate.
Yeah.
We're looking at that 6-7% mark as your base benchmark. More recently, my view on an investment strategy is about, I want to beat the rate of debasement. And this is something that, as someone who has done a lot of hours in learning about Bitcoin and its attributes, it was a bit of an eye-opener around this concept of debasement. And what that is currencies, whether it's the Australian dollar or the US dollar or the euro, those governments essentially print more into existence as time goes on. I think the rate of printing in Australia for the Australian dollar was I think 9x since the year 2000. So I think there's about 260 billion on the monetary supply of the M2, and now we're sitting much higher than that. It's 9 times that amount. So why is that important? Well, when there's more money flushing around, obviously chasing scarcer assets, scarcity comes into it. And I know we're going to talk about that at some point, but when it's chased around the same amount of goods, naturally the price is the only thing that can move for you to get that. And that's what we've seen. We've seen that play out, particularly over the last 25 years, and even historically well before the dollar as we know it. But So more money in the system, chasing a similar amount or the same amount of goods for things that are more scarce. And we take examples like beachfront property, precious artwork, they explode in the price you need to pay because there's so few of them, or the ones that are in very unique positions demand much higher prices because they just can't be replicated. So my view on investment strategy now is I want to at least match that debasement level. So I think it's running at, my calculations are running at around 10% or just under that. So I want to exceed a 10% hurdle rate from an investment strategy. That's my base case.
So when you invest, if you're investing $10,000,
Yes.
you want a return of more than 10% each year. Otherwise, you won't invest, or you won't choose that investment.
That's right. That's the hurdle rate. So if I can't see that the prospects after doing whatever type of analysis for that investment is going to occur, then that won't be an investment for me. So because what essentially I'm aiming for is to preserve or exceed my purchasing power. So at some point, money's there to be enjoyed. At some point, I'll either pass that on to my children and their children, or vice versa, enjoy it with my wife. But to do that, I want it to hold its purchasing power, grow its purchasing power. And that's the aim of money, that it can buy you a little bit more than what you had, or a lot more. So they're the unknowns, exactly how that will perform. But by doing some analysis around, that's the base, that's the hurdle rate. If it's borderline, then I generally will wait until the price will move that it's a bit cheaper, and I might be able to then get that hurdle rate of 10% plus. So that's sort of the last, I'd say, 5 to 10 years where I've evolved as a strategy. More recently, moving into the Bitcoin space, the hurdle rate is Bitcoin. So what do I mean by that? Well, the compound annual growth rate of Bitcoin has sort of been is 50% plus per year. I don't see that as being sustainable long term. However, what we have seen is that it has occurred. I think we're well over 70% for the last 12 months, but if you average it out, because it does move up and down over the cycle, but that is my hurdle rate now. So what do I mean by that? So if I have $100 to invest today, if the investment I'm looking to put in, the money to put into, cannot achieve a 50% plus return, then the money goes into Bitcoin.
Right.
It's as simple as that.
You're comparing every investment to Bitcoin.
Correct.
Yeah. And we've done an episode on savings. We've done an episode on inflation, right? And we've talked about CPI. This is episode 107. CPI, the problems with CPI, the reasons why that's not a reliable measure of inflation. However, even
2020,
suggesting that,
from 2020 to 2025,
we're looking at 22% inflation purely from CPI, which, as I said, it's not true inflation.
Yeah.
You're suggesting that the monetary supply growing at 10% in Australia, and if we look around the world, other countries is much higher than that. We're privileged almost in a way to only have inflation of the monetary supply at 10%, which sounds ridiculous because what we're saying and what you're saying is, I think, can confirm this with me or tell me that I'm wrong. You're losing 10% of your ability to buy goods every single year. Not just goods, but assets. So we can now see, when I say the word asset, most people think housing. Obviously, there's a problem in housing. Yeah. It's everywhere we see it and we feel it, except for generations who have paid off their house. Fantastic. Yeah. But over the space of 50 years, since the removal from the gold standard in 1971, this problem is getting worse for people. Housing. What can you talk to around housing, and what's your thoughts on why housing is so expensive? You're talking about investment. You're talking about a hurdle rate. How does housing fit in with that?
Yeah, I think what we've been, when we've seen for the last 30 years interest rates sort of decline. We had in the 1980s for our parents. They were living in interest rates. What were they? It was, mid-teens. We've really seen a steady decline over the last 3 or 4 decades down to what did we get in COVID? 2%.
We're getting
3%?
zero, yeah,
Yeah.
2% of
Okay.
what we're paying.
All right. So that is really conducive to real strong asset and inflation and asset prices rising. And we saw that no better than our housing market in Australia. I think we're in the top half a dozen countries in the world for housing affordability.
As in we're bad.
That's right.
Yeah.
To purchase a house requires 10 times your average income.
Yep.
Whereas I know when me and my wife in 1991, I think it was, we purchased a house for 3 or 4 times our income, and that's very significant and very different. So when we talk about inflation, I mean, depending on what lens you're coming from or what angle you come from, there are some things like whether it be fresh fruit and veggies that we see the seasonality of that. So you can sometimes, I think I remember buying broccoli earlier this year at $15 a kilo, and just recently, go to the markets and buy cauliflower or broccoli for like $3 or $4. So big swings like that, and that's just market forces and demand supply. So if demand can't soak up the supply that's available, then price falls, which then aims to pick up the demand side of it. So I'll buy more cauliflower, a little bit more, not too much because it only has a short life.
And it's cauliflower.
Yeah. I don't want cauliflower. It's not about, but you know what I mean? Like you pick up, the market will determine and move that accordingly. And if it needs to drop to $1 a cauliflower to move it before it has to be spoiled and thrown out, or it is spoiled, then so be it. But what we're seeing around asset prices is that I think that whether it's the generation before us, a lot of money has moved in to preserve wealth into housing in Australia. So I'm not sure if there's a clear decoupling, but traditionally interest rates were the guide to housing moving either positively or negative. So in other words, as interest rates fall, it enables people to borrow more and push prices up. So that's what you saw as a correlation. And then the inverse happens, whereby interest rates rising should see either flattening or a decline in housing prices. We're not seeing that so much anymore. I think in Melbourne, we've seen some sort of flattening of prices in the last 12 months or so.
Why do you reckon that is, to cut you off?
Yeah, so to me, the response to that is you need to put your money to work in an asset class of some sort. And what we are all familiar with and what is the system at play is that housing is the solution. And the government policy is very conducive to that. Whether you're an investor or you just want to, have as a utility, it enables you to benefit from that, because the view is there's an appreciation element over a period of time. Historically, that has been true, and that might be true going forward. But the price you're paying for that today is extraordinary. You mentioned earlier, I have two boys, 25 and one's turning 21, and the 25-year-old has a fiance, and they'll be looking to purchase something, or they would like to. But when you do the calculations for them, that his partner's a registered nurse, he's in middle management, so
very good jobs,
doing well,
right?
Yeah, absolutely, and credit to them. They've studied and they've gone into the workforce now. So earnings isn't the issue. It's more what's the lifestyle they're going to choose in purchasing some, and where does that need to be? So they're working through that. But if they were to do it now in an area around their family, it will equate to 10 times their income. And we live in outer southeastern of Melbourne. We're not in inner east, so or in Sydney in many of the suburbs and North Shore or something like that. So I think housing has now become where you park your money because you've got the appreciation. And I think when you combine the housing affordability in combination with migration that we've seen continues to come into the country, it does put pressure for those who are existing in the, looking to make an entry point for it to be affordable. And we just don't address that. We don't talk about that. I think the Minister for Housing has categorically ruled out for prices to fall policy that's just come out this week. think, what are we, the 27th of August, we're recording this.
Mm.
But from the 1st of October, you will be able to have a 5% deposit.
Mm. And the serviceability has changed too. You can now borrow more.
Yes.
And borrow up to 95% of the asset.
Without even mortgage insurance.
Yes.
Now, I can see from an affordability point that will bring more people into the market who might have been looking. But the rationale, there's reasons why we have these, not restrictions, but these criteria to enter the market. And that is that you're susceptible to a price decline. If something was to go wrong with the housing market and we had a fall of 10 or 15%, and you've bought $1 million property, that's a net loss or a paper loss, if you want to call it, of 150,000 on a 15% loss.
So then when you lose your job or you decide to move, you're stuck. You can't move because you can't sell the house because you owe more on it than you'll get back.
It has ramifications, right? When you have debt of $1 million or 950,000 on $1 million, because there are costs associated with housing of up to 3 or 5% when you purchase something. The serviceability element, firstly, you need income to sustain that debt. And that's the assumption that debt will remain
cheap.
Cheap at 6%.
Yeah.
I mean, what we will see, and I think what, the way I view it is we will see inflation run hotter than what we think at 2%.
Yes.
I think the Fed in the US has come out, the Treasurer has come out and indicated that if the choice is between inflation and getting the interest rate or the controlling interest rates, I think they're going to choose the latter and let inflation run a little bit hotter in order to try and get the debt in the US under control. And we tend to follow policy of that nature. We're not in the extremes of the US, but it is very relevant because we're in we're a Western democracy. So if the choice is inflation runs hotter, but they're going to try and suppress interest rates to try and sustain this scenario, how much of a free market do we actually live in? And we've seen that happen in Japan. And so the whole housing piece is, why are we creating this scenario and what does that mean for quality of life and what are we leaving to our next generations? And if you're not privileged to be able to have parents who have assets, whether it be housing and investment properties, or then you are, a real disadvantage, and that's a shame because, that explains why maybe our birth rates, explains maybe why crime, explains maybe why anxiety and depression and drug use and all these things transpire, and yet we continue to bring in migration at record levels.
Yeah,
it's sort of not making sense to me, and that's, as a citizen, I love this country, but I also am concerned on the direction that it's heading, and I'm not clear on why we're heading there because my parents were migrants, and so they had to work very hard and were given very little, but they built it for themselves. My mother-in-law has lived in her house for 60 years, and she's seen the change and the handouts that go to those who come, and we all need support at some stage, but there's also an element that it's a privilege to come into this country, and we should celebrate that everything we have, and not take it for granted. And housing is really at the core, because if you can't have somewhere comfortable to live and it's affordable, then every other expenditure flows from that because your discretionary spend is just reduced enormously.
Yeah. And that affects your quality of life. And what you've explained there is that housing's become a store of value.
Yes.
It's Tina, in a sense. There is no alternative. The Australian labourer, average person, knows housing goes up, safe as houses, so they put their money into that. But it's a utility. It's to live in, a roof on your head. And the question that I had upwards of a year ago now, before I found Bitcoin, was that why do I have to work for 30 years just for the luxury of paying off shelter?
Yeah.
There's something not right with that. And because it's developed this monetary premium with people storing their money in it, that's why housing has become so affordable. Like you said, the government is also putting props in along the way to allow this to continue because they don't want it to collapse.
Yeah.
One, for their own benefit, and we're all incentivized by what affects us and incentivizes us. And then two, because if houses do drop 20%, banks can become insolvent, and that's a bigger problem. And so potentially immigration is looking to replace the birth rate that we can't do.
Yeah.
So it's like, what came first? And I've talked about immigration before, but I completely agree with you and with other people out there that it's a problem. We need to look at it as a society and think, what are we doing and why we're doing it? What direction are we going in? And without becoming an extremist on either point of view,
Yeah.
let's look at the facts, and you have the facts. That's why you're here.
Yeah.
So that's housing. If we talk about cost of living and inflation as well, cool. They might say inflation is 2%. You've explained that it's 10%. Monetary supply is 10%. And then we've explained in another podcast that inflation, or CPI, Consumer Price Index, the price of a basket of goods, that again is manipulated. It's not true inflation. Even that's been higher lately than in the past. It's higher than 2%.
Yeah, if you look at, I think inflation is all encompassing, isn't it? It's your day-to-day items that you're purchasing. You look at your energy bills. We are an energy-rich country, and I think I read some data around that we're in the top 1, 2, or 3 producers of pretty much most resources that globally are in demand.
Which is ridiculous compared to our population of 27 million.
It's we are so privileged.
And that's why other countries need us. China needs us. India needs us.
Yeah.
America needs us to export to them.
Yeah. I'm not sure why our own interests aren't served first. So, my philosophical view is, if we were to serve the country's interests and allow then companies to profit, because I am a capitalist. Don't get me wrong, but capital at play shouldn't come at the expense of its citizens, because those resources are scarce. Believe it or not, yes, we have a lot of certain things, and maybe we have greater supply than demand at this present time, but they will become scarce at some point, and we shouldn't be taken advantage of, or essentially be paid peanuts for these in royalties, if you want to call them any royalties. So that's a concern, and not only that, we have an aging population, and my mother-in-law, my mum, they're paying $300 per month or every 2 months to warm their house, but this is to enable profitability. But then we're sending these same resources globally, and we've got players that are making more money off that. Like, we're not securing our own needs, and I struggle with that, because if that's something we can do, that can make a big difference. And if you look fundamentally at a functioning economy that's thriving, energy sits at the base of it. Good thriving economies have cheap energy. If you can provide cheap energy, it enables business investment to occur and enables pretty much onshoring to occur, because it's a competitive advantage. And so what we're doing is we're disincentivizing this because of the expense of energy. And we're seeing them in different industry. I think we had a major glass provider move overseas recently out of Victoria. And we also, coming from a small business, it's something that's grown in price something like 60-70% over the last 5 years. So if you're running, my wife ran a cafe and I was assisting her, when your cost of energy goes up 50 or 60%,
that's your margin.
That's essentially, you are left with low single figure margin. And that presumes that the cost of getting in a tradesman to fix something, forget it, your margin's gone. And that's without having debt. Now, if you're running debt on top of that, what's the incentive to be a business operator in that environment? So I'm not sure whether people in government understand, having not maybe worked and ran their own business, that this is the ripple effect that goes on.
Even if they have, maybe it was 5 years ago, maybe it was 10 years ago, things change.
The implications, yes. As things evolve, what does that mean? And as much as you try and put prices up, okay, you can go out and eat at a cafe for $25 of a meal. Maybe you might have done that twice when it was $12 or $15, you might be lucky to do it once because, again, the affordability or the discretionary spend, it has reduced. So the viability of a cafe existing is now being put into question. And yeah, prices are rising, but there's only so much the consumer can absorb or the business can rise.
Otherwise, they decide that it's not affordable. The hurdle rate for me running this business isn't worth it. Therefore, I will shut down.
My advice to my wife was, why are you doing this?
Yeah.
If my hurdle rate is Bitcoin
Yeah.
at a compound annual growth rate of much greater than 10%, or we're talking, in 50%, then, and we don't even require that, then why am I doing that? Why are we putting our hard-earned time and energy to get a return in the mid to low single digits?
Talking about scarcity, your most finite asset is your time.
Yes.
So let's touch on, again, focusing on the problems. What are the problems? We've talked about businesses. We've talked about housing. Let's talk about the fiscal dominance and the debt problems that we have in America, and more so in America, I think, because Australia has a very different debt setup. Most of our debt is private debt, which means yourself and me with mortgages and business debt, as opposed to the government's debt. So in America, they have a very high government debt. Did you want to speak to that?
Yeah. I think this concept of fiscal dominance is worth unpacking, and for those if you follow some quite macro sort of people like Lynn Alden or Luke Groman, like they really talk well to this fiscal dominance that's underway and has been occurring. So I encourage people to check them out. But the whole notion is, I think it's broader than just an economic sense. I think it's the concept that the government has solutions to so many different problems. The biggest one in Victoria at the moment, or in Melbourne, is, we had an outbreak of machete knife attack. And so the government's response is firstly to ban them. Well, the knife attacks continued. And the second response has been, we're going to spend $34 million for, I think it's about 65 bins to be located for people to voluntarily put their machetes into.
No CCTV is watching you guys. Don't stress.
So it's an example, and as much as I'm picking on that example, but there are many more along those lines that it's as though as a community or a society, we think that the government have the solution to a problem that really comes down to, if somebody does, I suppose, commit a crime of that nature, are the police in a position to hold responsibility and accountability for those once they're caught? And does the court system make it disincentivize it to do that? And that's a question, right? Because I don't see the outcomes like that. I don't see protecting our own home space example. How can I protect my home when someone can just come in and get a slap on the wrist for invading my home? So if there's no consequences to actions, then there's no reason why people wouldn't do it.
The perpetrator is weighing up a risk and reward.
100%.
The reward is I can rob this person.
Correct.
The risk is I get a slap on the wrist.
So
it's a no-brainer for them to do that.
So in countries like Singapore and Dubai, some of the attributes that they have is, if you intend to do that, or you do that and you get caught, you'll be deported, or secondly, you'll face harsh penalties. And that's a disincentive. Now, whether that in combination culturally is an acceptable society,
and there's a spectrum there. You don't need to hit the polar opposites of each, but you shouldn't be letting them off and then continuing to pay their welfare or something like that along those lines.
Well, the irony is that we continue to look for more and more police to recruit police for the police force itself. So yet the powers that they might have and the ability to enforce to get an outcome, they're, as much as they're a deterrent in walking around, the deterrence comes from, if you do this, this is what you. So if you take that risk, the consequence to the action, and that we all live by that. I'm a free markets type of guy, so I know when I put my dollar at work, if that investment isn't appropriately analysed, the risk is I lose half the value of that.
Yeah,
I don't ask the government to bail me out.
Yes,
right. Whether that's investment in a house, investment in an equities, which are shares, or in something like Bitcoin. or any other crypto for that matter. So it's a conscious decision, and yet we have a scenario that we look for mitigating factors, which, they're relevant at times, but at the same time, there's got to be more consequences to actions. And I think that's at the base of any society that needs to function and prosper and move ahead, because we can't continue to have 8 out of 10 jobs that are created in our country in the last 10 years that are public service related.
That means the government's paying for it. The government is funding that wage, that income is coming from the government. So then you're weighing up
So who's paying? How does the government get its money?
Through taxes.
Through taxes. So what have we seen, and what are we seeing being proposed? I mean, the productivity is more and more taxes. The productivity session over the last week was about, okay, what are we looking at? Some inheritance tax, a death tax. We've already seen property taxes here in Victoria. For those who have more than
bedroom tax,
a bedroom tax being proposed.
What about the what was the word of it? It was, let's say, for example, you've paid your house off, because you could have been receiving $35,000 of rent. You now have to pay tax on that unrealized rent.
Wow.
Now these are just. I think it's a scare tactic. I think that's behavioral psychology at play, where let's give all these crazy ideas out there. We won't do them, because then when we actually introduce one, people will accept it with open arms. That's the psychology behind it. So they're not going to do the bedroom tax, and people are like, phew,
but they'll do something
else that screws you.
Yeah. So it goes back to, fiscal dominance or fiscal issues is how are the government functioning? And just to put in perspective, our federal government receives something like, I think it's just under $800 billion in revenue for the past financial year. So you'd say to yourself, so as a country, they bring in $800 billion, and yet they are running a deficit of about $40 billion last year. It's about 5%.
So they're bringing in $800 billion, but then they're spending $1.2 trillion.
I think it's 840 billion.
Right.
They're running 40 billion over. So
40 billion, sorry.
Billion over, yeah.
Okay.
So, and this is, so the expected, so the Treasurer, Jim Chalmers, has come out and indicated for the next 4 years, we will continue to grow our revenue, taxes. Because
how else do they get their revenue,
yeah,
right?
So
they're not making trinkets.
Yeah. The biggest way that is generally personal income tax, and it's called bracket creep. So we all need to earn more, and as we earn more, we go into different brackets, right? So although there's some adjustment occurs to the brackets themselves in taxation, you go into bracket creep where you pay more taxes. So as their revenue goes up, the expenditure continues to go up, or if not more. So our debt expectation, so our we'll be in about $1 trillion of debt as a country, gross debt. Within the next couple of years. Now, I don't know about you, but we are an energy-rich, prosperous, first world country, and we're sitting on $1 trillion of debt in the next couple of years, with the outlook that we'll continue to run deficits, because everybody looks to the government for the solution to whatever problem. If we have a steelworks which can't function in a market-based economy, is inefficient or cannot use its money appropriately, or is heavily debted, because there's some jobs associated with it in a regional area of South Australia, the government will bail them out. Or the government during COVID provides Qantas, I think it was about $800 billion to ensure that our national airline
didn't take stock, take ownership of the company.
Correct.
Just gave them that money for it to survive.
So, and Qantas has since absolutely thrived.
Shown profit.
Record profits. Its market capitalization, its value of the company is at record highs. So,
can I just clarify one thing?
Sure.
So when you say the debt will continue to increase, the deficits will grow, is that because, one, inflation and wage rises in the labour that they're funding, paying nurses, teachers, police officers, unions for creating the Westgate tunnel, things like that, inflation, as well as what else would create, and then giving more and more jobs.
The growth of the federal government expenditure is projected to grow are greater or equal to the revenue growth.
Yeah.
Which means our deficits continue to rise.
Yeah.
So there's
is
no
that
view
why?
of running a neutral. Well, I think I looked at some data around pre-COVID or in the last 15 years. The size, our population is, and I think it's, when you see government debt rising, the way I perceive it, or I sort of try and relate to it, is for a government to increase its expenditure, a federal government to increase its expenditure by 40% in the last 5 years or so, has our population risen accordingly? Have the services we get warranted because our population warrants them to assist, right?
Right.
And we haven't seen
Because we
that.
pay for them, we fund them, we choose them, we allocate.
It comes with the cost.
Our
That's
money
right.
goes there.
Then there's infrastructure. So, I expect, and I don't expect to be a 1-for-1, right? Because that would be a poor use. So if every person if we grow the population by 50% and there's 100% increase in expenditure, then why are we, what's the reasoning and rationale why we're bringing in so many people? But we haven't seen that. I think the increases in the number of migration has been around 15 to 20% over the last 5 years, which is still very high. I think we're tracking at 600,000 to 700,000 people, migrants being brought into the country.
And you're talking there about, just to clarify, you're talking about the percentage increase of previous immigration to current immigration levels increasing at 20%?
No, increasing it on our population base, total country.
Our total population
yes,
has
increased
increased
15%.
15%.
So population up 15%, expenditure up something like 40 to 50%. So why is our federal government, when we've only got a population increase of 15, 16% or thereabouts, growing its debt or growing its expenditure by 40 to 50% over a 5 to 7 year window? That I ask, why I don't think that's a great use of our money. Now, it goes back to we're living in an era.
Investment view, right? And you form that view because you understand investing and you understand the balance sheet. Is that like,
it's also saying, what are we getting as a return? So if we are receiving some amazing services, if our if that money is being put to cheaper energy, like as in we're subsidising to ensure our older generation,
greater
healthcare,
householders, NDIS,
yeah, like it can be used if the return on those monies has led to a prosperous society in both socially, in crime rates being down, in communities being formed, in our capital per GDP per capita is rising, so our quality of life improving per person, then you would say it's a good use. We're heading in the right direction. But we have seen, I think over the last 2.5 years, nearly every quarter, barring 2, we've had a negative GDP per capita return. So in other words, we are getting poorer as a society. Our quality of our life per person has declined. And if you break it down, that does translate on a day-to-day basis. For those who are earning a basic wage and have to rent or vice versa pay a mortgage, ask yourself what's left after that.
Majority of people you're talking about. Anyone
Absolutely.
under 40.
Correct. So it's really excluding people who are, living with their parents still.
Yeah.
But even if you are living with your parents, how expensive are things? Whether it be, registration, insurances going up, and then you've got, subscriptions or mobiles, and then you've got day-to-day or going to have a drink with a friend.
$15 for a beer at a pub.
So they're just real, factors. Now,
there's real life implications to all the. You're very data centric. You're very knowledgeable in what's happening, but these are the real implications you're bringing it back to as well, which is powerful. So, is there anything else you want to add to the fiscal side?
Yeah. So I think what I would ask is, like, think of instead of us looking for the government to be the solution to problems, quite often issues resolve themselves by free market forces. And I'll give you an example of distortion that occurs. So pre-COVID and pre-NDIS, to obtain a cleaner to clean your private residence. I'll use this example because I'm assisting my uncle in having a private cleaner come in once a week. So it's a really good example. it was about $20 to $30 per hour, depending on what
I already know
services.
where this is going because the NDIS has come in. They've said this is the market price for a cleaner.
Yep.
So someone is applying for jobs. You've said, look, we can pay you $30, $40. They're saying, why would I do that when I can go clean the NDIS for $54 an hour?
Correct. So what we've seen is that example that you talk about, when you've got, as much as we're bringing in the immigration quite heavily, and I can see why we might be doing it on one hand because we see a need, what it actually has done is that whole system has distorted the entire market. So now a cleaner for a private residence is minimum $50. So it has doubled within 5 years. Now, and then you've got the question of, okay, so why? We're not asking for anything more. In fact, the tools available are probably more efficient to clean. But what's occurred is, if that is the competitive landscape, but it's been mandated, it's actually controlled by a central authority, now that is the market rate. Because you're right, what it is people can compare and say, well, I can get $50 an hour there. Why am I going to go for a 25 or 30?
And they might do your job for a bit until they build up their business and then they go goodbye because I'm going to take this rate over here. That's simple business. That's basic economics and human nature to survive.
So
but you've got two factors:
yes,
the depreciation of the money and the inflation as well.
That's true.
As well as the government regulation and bringing in a floor in a pricing.
That's right. So that example there does not only go to the cleaners. That then goes to tradesmen. So when a tradesman is quoting a government-orientated task, anyone, it's generally inflated, that price. Whether that be 20%, 30% or 50%, the price that is quoted is much higher. So now what in an electrician, and so for a private resident to bring out an electrician or a plumber, you're competing. And so the rate just to bring a plumber out is a call out of $100 or $150, and then you've got, $80 every 30 minutes from there. So it's a $500 bill or a $400 bill for just getting something looked at. So you've got distortions occurring. Why are we saying, and that is an intervention. You've got a central body, being the government in this case, who's intervening and distorting things. Then you have a central body like the Reserve Bank, who are then, debasing the currency by releasing or banks creating more and more of the currency, which is basically competing for the same amount of goods or assets. So you've got these distortions occurring. So, and it really puts our future generations saying, how do we move forward in this environment? And for those who don't have assets, you're at a significant disadvantage. And that hurts because it hurts.
Which is young people.
It's young people. Yeah. It's the future of the country.
Yeah. And so I love this line of thought because when you're a young person and you've got no assets, you're feeling nihilistic. What's the point? Why the hell should I even bother to save for a house when a house, a half decent house is going to cost me $1 million?
Correct.
And I'm struggling, and I'm on my $60,000 per year job. I'm a single person. Good luck. You can't do it.
Yeah, even you spot. Just do the numbers on that. If the $1 million home in an outer suburb, whether it be
after tax
cost, and you're earning $60,000, you're able to save at least, if you can save 20% of your income or 30% of your income. So your saving patterns are very good. Which is very good on a $60,000. If you can do that on a high wage, you're okay. It's more, but you're talking of, on a 30% saving on 60, that's gross 18,000. If it's 18,000 gross, let's say it's net 15,000.
Yep.
If that price of a home grows by 3% per year, $1 million home is $1,030,000 in 12 months. You're each year you're falling further behind.
The gap is growing and growing and and growing. And this is a conversation I have with people all the time about house prices. And if you have a $500,000 home and it's growing at 5%, or you've got a $1 million home or a $2 million home, when you're in the $500,000 home, you will never catch the more expensive assets, because as they grow 5%, you're falling further and further and further behind. So if you try to compete in housing, you won't win. You will never catch up. The movement of putting your money in a house and going, I'm sweet, or buying 15 houses and It doesn't work anymore. The times have changed.
Yeah, well, the only challenge there is all the regulation, all the policy, and the dependence on this system continuing is all supportive of the system continuing to roll that way. So we're seeing government policy, like we just spoke about, continuing to reinforce this message. You're continuing to see tax policy, negatively geared, continuing to reinforce this. So all the tax advantages that come with it are still there. So it's not going to unwind anytime soon. So
yeah, right.
The concept of kicking the can down the road.
It puts the floor in there.
Listen, it might mitigate it, but reality is they want this system to go. Let's remember what's at play here. When you transact, a transaction on stamp duty, I think Victoria's got the highest stamp duty in the country.
Yeah,
is anywhere from $30,000 to $50,000 income for the state government. This is an income generator. Let's not get this wrong. So if we see a 20% decline in house prices, that's revenue for our state and federal government or state governments nationally, right?
Yeah.
So
that are already running the deficit.
Correct.
And this is the fiscal dominance that I think we can revert back to now in the US.
Yep. They
want interest rates to come down so the interest repayments are lower.
Yes. So the US is an amazing, always someone to keep an eye on, whether you want to delve in deeply. But Lynn and Luke Roman just absolutely cover this space really well. And I'll try and sort of steal some of their thunder. But the facts are the US current debt is 37 trillion. Their future obligations, so just at 37 trillion. Let me pause there.
It's 12 zeros, 37 with 12 zeros.
And that is growing at $1 trillion per, I think it's something like...
Is it quarter or year?
Yeah, it might be every 6 months, So they're running a deficit of something like 2 trillion
that's
plus per year, the government are. But the debt is growing at $1 trillion every 3 to 6 months, depending on with all these tariffs coming in, and we'll get to that shortly. So that's just their current debt that they have to continue to refinance, and they're all refinancing on short terms because no one's giving the markets who buy these treasuries and bonds are not interested in long-term treasuries anymore, because there's a real question mark on how this printing that has happened in the US on its serviceability and the continuing. So markets are saying, I don't want to be rewarded at 4%, which is the 10-year treasury, 4.3% thereabouts. I want higher return for the risk because I see more risk now. In the past, that has been sufficient. People have bought that debt, bought those treasuries, bought those bonds.
Yeah.
But now they're saying we're not buying 10-year treasuries. The market has significantly dried up. There are still some buyers, but we obviously know, countries like China are no longer. In fact, they're a seller of treasuries. So they're
I'm wary that we could be losing people with this line of thought, but what you're saying is absolutely appropriate. And what you're talking about is a hurdle rate. Again, it's investors in US government debt, which is our pension funds, our superannuation, sovereign nations around the world buying these assets, these US treasuries, and they're saying...
But I think the key point I want to stress here is this amount of debt that continues to need to be refinanced, it doesn't go away. The numbers are the numbers. You can't just go to sleep on it, right?
It's going like that.
You either default, which is a whole new, which they won't, or you print your way out of it, essentially. And the printing is what they've done, just like we have done, right? But we're not in as much debt as a percentage of our size of our economy, our GDP.
And we're talking government debt.
We're talking
in America,
government
debt.
Federal government debt. So the implications on the 37 trillion are that that needs to be constantly funded, right? Because they can't shut down. It's still the biggest market
of the economy. They can't turn off the US war machine paying for defense.
That's right.
They can't turn off
welfare. Welfare. I mean, the four biggest expense lines are defense, Social Security, and Medicaid. And then you've got interest.
The interest on the debt they already have. They're paying $1 trillion.
Over $1 trillion.
Our level of debt, they're paying that every 6 months.
Yeah, that's correct. So that's rising. So that's in interest. And so what the government now are looking to do is they've got a decision, and Powell came out, which Powell is the Treasury, so essentially like a CFO of a company. He came out over the last 7 to 10 days and indicated that if there's a choice between running inflation hotter and bringing down the interest on the debt, he's going to choose running inflation hotter and bringing down interest. So now it's called like yield curve control. They're going to force interest rates lower. So they've been on a consistent questioning of Powell, which is an independent, the governor of the Federal Reserve, challenging him around, why aren't you bringing interest rates lower? He will be turned out over the next 6 to 9 months because his term is up.
They'll get rid of him.
And their appointee will be someone who will do yield curve control or thereabouts.
And that is the Treasury printing money to make sure that interest rates come down.
And control where they be.
So if other countries try to sell their debt, that would generally raise the interest rate in America. But then the Treasury will come in and buy it and put a stop so it stays low for people.
Which is what Japan's done for the last 30 or 40 years.
Right. And so without getting too into the numbers,
that's right.
We're talking big picture. These are the problems that are facing everyday people. It is way more complicated than, it's just immigration.
Yeah. So just to bring it back to a bit of a real life scenario, by taking that approach, and if that's the approach going forward for the next 3, 5, 10 years, what we have as a situation is that as an investor, as someone who wants to protect their purchasing power, with so much money being printed to keep this situation continuing, it means you need to place your money or have assets that can match the inflation that's going to come. And again, I'm going to go back to the real inflation rate I would call out is the debasement that is occurring, which is the range of 7 to 10% a year. So if you go to the higher end, the 10%, that is your hurdle rate, your base hurdle rate. And because that is the likely amount of debasement or printing that's going to happen.
So if you keep your real life, if you keep your money in the bank and it's earning 5% interest, Jerome Powell is telling you that's going to come down. It will no longer give you 5% return, and you're competing with 10. So if you keep your money in the bank, you're going backwards.
Yeah.
And so it comes back to what is money, and not only that, what do we want it to be? Because there's a course I've created around the history of money and investing.
All right.
And the history of money has evolved. Money has changed and will continue to do so.
Yeah.
We've got 140 odd currencies that have already died and gone to nothing.
Yeah.
They've failed. Our currency now is the Australian dollar. We know it as coinage and notes, and now it's mostly digital, seen in an app.
So let's just on the Australian dollar. It's important to recognize that the dollar that we have, there's more of it in circulation. Fact. Our dollar, go back 50 years, so 1975 or thereabouts, the dollar purchased far greater than what it can purchase today.
Fact.
So whether it's you looking at...
There'll be a graph there right now.
Yeah, that's right. Whether it's a housing comparative, and that's an important one, I think it's a real relevant one, or whether it's, purchasing a bag of lollies or some milk and eggs. Those things are clear comparatives. So I think your point around what constitutes money, well, the Australian dollar is one, but what we're seeing and what we've seen historically is that as countries and civilizations evolve, those in control, the central authorities in control, and what we're talking about here is governments, they continue to debase because it's a form, it's easy and it's lazy and it's a form of theft.
They'll do that because it's easier to just do it and debase the currency rather than tell people we're going to tax you more.
It's a subtle,
even though they're
doing theft.
They're doing it both. Yeah. They're taxing you more 100%. And then inflating you.
Yeah. It's a subtle theft that continues to fly through. Just look at all the forms of taxation that are occurring, and inflation is one of those. They talk about inflation as though it's not in control. Well, when you keep printing at 7 or 10%, you can control that. Economies that haven't done that, or countries that haven't done that, have much more stability. they're running much more disciplined methods, and this all leads into Austrian economics.
Switzerland, I was going to say, for example, they have the lowest inflation, and if you look at their dollar versus the American dollar, it's phenomenally outperformed because it holds hard assets like gold, right?
Yes.
We're talking now about, we haven't even touched on Bitcoin. This whole time, we're Bitcoiners.
Yeah.
We've been talking about the problems.
Yeah.
Understanding the problem is fundamental to then seeing what is a potential solution.
Yeah, but if we talk about, I think the money thing is, so we know it as the Australian dollar. We know fact it's been debased, or there's a lot more of it in circulation in any period of time, and it'll continue to be more into the future. So if you are somebody who's looking to get ahead, if you are saving in the Australian dollar, and the facts are that the government and the Reserve Bank of Australia will continue to print more to fund these deficits, then your dollar purchasing power will decline over the next 1, 3, 5 years. So therefore, your choice is, do I keep my money in cash or a term deposit, or do I put it in an international equities or Australian equities, which are shares and ownership in companies which have worked on an average of around 10% a year or 12% a year? Or do I look at other alternatives such as housing, and will that perform and match that debasement or that printing that occurs, or that inflation that I refer to? Or do I look at a strategy like having exposure to Bitcoin or learning more about Bitcoin? And I think as we go through our discussions, I think it'll be pretty obvious on where you should put some time and energy into, because we work so hard. We work so hard, at least 40, 50 hours a week. And if you're running your own business, we're talking 60 hours a week. I encourage us to spend some time to learn about money.
How to keep it, how to keep that money that you earned.
Right. So learn about and how you can preserve the purchasing power of it. And it's so fundamental to prosperity for you as an individual, your family, generations, but more importantly, the globe, and peace and prosperity, so we can actually humanize things. There's a lot of hope that exists in that space.
So I saw a video of Drake, and he opened up his vault and he had like hundreds of thousands of notes in there. And I just thought, okay, that's a bad idea, because it's going to inflate away to zero. If he's got it there because doomsday happens, he's got cash, cool, that's okay. But so many people around the world don't understand that you cannot store the money in money. So on that,
or you can
but you're going backwards. You go to zero.
But you just got to realize there's nothing wrong in taking. You got to remember what the system at play is telling you. So all the norms that we've all grown up with this is the playbook that works. You work hard, you save a portion, you
buy a house,
you then borrow a lot of money, or borrow money, whatever multiple of your income, to purchase an appreciating asset, being a property generally. Because shares are a relatively new phenomenon, and
they're scary.
They're volatile, right? And we haven't even talked about cryptocurrencies or Bitcoin. So and then you lever yourself, because all the incentives are around that, and the government benefit because they're getting all the tax revenue from those. And the asset price appreciating, and you get those benefit, and you feel richer, which then means you spin and the flywheel continues. But the question is, can that continue? And how much, can we get to the average property in Melbourne or Sydney being 3 million or 2 million, and Melbourne being 1.5 million? I don't know. I don't have a definitive, but what's the saying? The harder you stretch the elastic, the more severe the break is, because when you stretch so far, the reaction is going to be more severe.
And if you just happen to get the timing wrong, which is completely luck, you'll never know. You don't know, I don't know what's going to happen with housing into the future, or any asset into the future.
But I think it's understanding that could work. It's that asymmetry, I think, again,
the risk asymmetry.
Andrew Page on this one, the asymmetry. The upside of investing into a property that's negative yielding, in other words, just on the core interest payment on what you yield is negative. Let alone
what a
the
ridiculous
expenses.
premise.
It is, you wouldn't do that with, it's a phenomenal presence on the reliance of the capital appreciation with so many variables there. The upside might be, a 5% per annum or a 7% per annum. And that might be sufficient for some people because it's, they might already have equity or they might have that exposure. So for some people it might work, but will that maintain your purchasing power when debasement or currency printing is at 7 to 10%? So essentially, what I am suggesting and what we'll, I'm sure, unpack is there are strategies that you can employ that you essentially are jumping on the fastest horse in the race. And what does that mean? It means the property of a price, the price of a property is actually cheaper as time goes on because the appreciation of an asset class such as Bitcoin is so much greater than property, shares, cash, or any other investment.
Yeah, what you're talking about here, from what I've gathered, is risk. Like everything carries risk. You keep your money in the vault, there's a risk attached to that. Inflation happens. You keep your money in a property, there's risk attached to that. Does it go up? Does it go down 40%? You've made that choice. Don't lie to yourself and say that, I don't invest, because everything you do with your money is an investment. Putting it into the long-term savings account, that's investing.
That's your choice. Yeah, that's right.
Saving and purchasing a house, that's investing. Putting it into the stock market, that's investing. Going to the pub, you're investing in your happiness and your time with your mates.
Yeah, that's right.
So you are investing, and there's different levels of risk attached to every single one of those options.